Thanks, Nirav. Good evening, everyone. On behalf of Asian Markets, we welcome you all to the 3Q FY20 earnings conference call of Elgi Equipments Limited. We have with us today Mr. Jairam Raj, Managing Director, representing the company. I request Mr. Jairam to take us through an overview of the company's performance and the results, and then we shall begin the Q&A session. Over to you, sir. Thank you.
Thank you, Kamlesh. Thank you for organizing this call. Ladies and gentlemen, it's my pleasure to be with you this evening. I will take you through the performance of the company in this quarter in comparison with the quarter of the prior year. I know the results look on paper, they look quite gloomy, but I'm sure that with my explanation at the end, you will realize that the story is not so bad. When I'll take you through the reconciliation of the EBITDA between this quarter and the prior year quarter. Starting with sales, we did 463 crores at a consolidated level, as opposed to about 470 crores last year. Against a contribution margin of 39.4%, we have improved it to 40.6%. So, taking these two sales numbers, the EBITDA, assuming fixed costs and people costs are at the same level as last year, our EBITDA should have been about 530 million, 51 crores. Against that, it's approximately 30 crores. So, I'm going to take you through a reconciliation for almost this 22 crores of reduction in EBITDA. So, the biggest cost that has hit on our EBITDA is people cost, and I would like to dissect the people cost and explain to you. Out of the total people cost, as you know, as I've explained in my past calls, we have embarked on a strategic initiative in Europe. Towards that, we have been building our team in Europe. I would like to now step back and give you a little bit of visibility into what our initiative in Europe is. We are going through an organic growth model in Europe. Our plan is to add close to 70 people to our team in Europe, and we are entering all the markets in Europe except Germany. And towards that end, over a 3-year period, including starting from 2021, including this year, 2021, 21, 22, and 22, 23, our loss that we expect out of Europe is close to about 20 million euro. That converts to about 160 crores. Now, against this investment, I call this loss an investment, against this investment of 20 million euro, approximately 160 crores, we expect a top line in the 5th year of close to about 75 million euro or close to 80 million euro. Now, if I look at this growth and compare it with an opportunity which is inorganic for an 80 million euro inorganic opportunity, at the current valuation, roughly similar to what we did for Michigan Air, the price that we would have had to pay would be about close to anywhere between 60 to 80 million euro. Now, against that, our investment is going to be 20 million euro, and in the 5th year, by the end of the 5th year, we would have recovered this investment. And this plan has been done with high levels of diligence, right down to each market at each distribution level. So therefore, we are reasonably confident, considering the success that we have had in Italy, that we will be able to execute on this plan. So this is the context of our larger European plan. We'll talk about this later. Now, if I funnel that plan into the Q3 results, We have had close to 55 million in people cost, which is additional specific for the European project, the initiative in Europe. In addition to this 55 million, we have had close to about 100 million of additional people cost, and this has been primarily one of the biggest challenges, biggest investments in people has been in India to the extent of almost 35 million. And this we did last year in anticipation of a continued growth of the economy. We have already started working towards rationalizing these costs, and I'm very confident that in 2021, we won't see this. Excuse me?
Sorry.
I don't anticipate these costs to be continuing on the same trajectory for 2021. But this is an investment we made anticipating that we will be growing India to the extent of almost 18%. But what has actually happened is a degrowth to the extent of between 4 to 7%. So, again, this is a unforeseen expense which we will get back on the track. Other than India, we've had some investment increase in cost in the US and in Italy, but these are not significant in relation to the performance of these units, so I'm not too concerned about that. The other reconciliation is the other fixed cost, and in Belgium, as part of our recruitment of our talent and getting the talent on board, whether it is headhunter costs and all that, it has been close to about 30 million, which is going to go away. It is not going to repeat itself. On a regular basis, we have had some one-time expenses that I'd like to focus on two. One, in the US, we had a plan to sell our patents property for close to about 9 million, and we were looking to acquiring a smaller facility for about 4 million. We had signed the agreement for the sale of that property, but unfortunately, when the buyer went for approval for a building, they found that the wastewater capacity of this particular property was not adequate, and the city of Charlotte is working on increasing the wastewater capacity, and therefore the buyer backed out. But in the meantime, our plan to buy the new facilities, we have gone ahead and we had paid a deposit, which we had to write off because it went into an escrow and we had to give up an escrow. That was to the extent of about 15 million. The other pieces, we had a bad situation in the Middle East where we had sold machines against post-dated checks, and we realized subsequently when we deposited the checks that the buyer was a criminal-minded person who had done it to not only Elgi and to quite a few other equipment vendors where he was buying equipment and selling them off, and now he's absconding from the UAE. He's an Indian national based out of the UAE. So these two costs are close to about 27 million that are one time that have hit us in this particular quarter. So if I normalize for all these costs, except for the strategic costs in Belgium, which is to the extent of about both people cost and fixed cost, which is about 85 million, our profitability has been pretty healthy in spite of challenges in India. So this is a broad reconciliation, and I will rely on your questions to get into specific responses. Stepping back to give you an overall context of where the markets are, I will start in Australia. The Australian market and our growth has been pretty positive. In spite of the fires in Australia, we've continued to the requirements, the inquiries, and the orders have been continued to remain. And the team's expectation is that we will have a good year in Australia. Southeast Asia has been a challenge. Specifically, I'm looking at Indonesia and Thailand. We have not done as per our budget. We have had marginal growth. So at the end of the year, we will not be meeting our budgets there, but we will end up slightly better than where we were last year. India has been a challenge, significant challenge across almost all the verticals. The inquiries, which in the third quarter, when I talked about the performance in the second quarter, I had said that inquiries continue to be there, but finalizations are getting delayed. But right now, the inquiry itself has become a little less. So we're not able to interpret the economy. And now with the new budget, we don't know the consequences. So we are taking a very cautious approach in India. We still remain optimistic in terms of the market opportunity. We are looking inside rather than outside for how to leverage the opportunities that we have not tapped in the Indian market, and we see some potential which we are going to look and leverage and deliver on for next year. So overall, for next year, I would say this year India is a bit of a wash. But we have already started working on preparing to strengthen ourselves for next year. So I'm reasonably optimistic for the top line for India next year. But in terms of our cost management, the lesson that we have learned is not to put costs up front on the basis of an optimistic top line. We're not going to do that. Even though we have an optimistic top line view for next year for India, our cost management is going to be very tight on the basis that India is going to be flat next year as well. Middle East, barring these one-time problems with bad debt that we had, has had a good growth in the top line, and we are on track for our plans where we went direct in Middle East about a year and a half ago, and our top line is beginning to support that strategy. Moving on to Europe, I will talk about Rotair in the context of the US because there is a link there. Europe on our industrial side continues to do well. We have grown in Italy this year as well, and we are beginning to see green shoots coming in, even with the little team that we have built, the smaller team, not the full complement of the team. Whatever team we have built in Europe, we are beginning to see some very strong order books that are beginning to happen. Moving on to the U.S., Patterns has grown compared to last year, but it's not done as per our budget. But we are seeing the BCG project initiatives that we have done in Pattern, the reorganization that we have done. We're beginning to see very solid traction in the market, and I'm looking forward to Patterns doing the high levels of optimism. And the same thing I can say about LG Industrial outside of the Patterns area. Patterns Medical was a huge challenge for us. There's been a significant drop in the revenue compared to last year, and this can be attributed to two facts. One, we had one of our key distributors was acquired by a competitor, so we lost a big account there. And one of our key sales representatives had a medical issue, and because of these two reasons, we lost a little bit of traction in the market. We have taken on board two strong sales resources with industry experience. So I expect Patterns Medical to come back to the levels that they should be in terms of the potential. Brazil continues to be a challenge. In spite of that, we have grown marginally and we have grown profitably. Earlier the subsidiary was making a loss. The losses have been stopped, and we are also looking at generating cash in the subsidiary. But I'm not going to celebrate that too early because the economy is still kind of a little uncertain. But there seem to be some green shoots in that economy. So this is really the summary of our business across the world. In terms of, I've got some more points that I will talk, but I think there will be questions that will cover those points. If they don't, then at the end of the call, I will come back and talk about it. So thank you again. So I look forward to your questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question, you may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder, you may press star and 1 to ask a question. The first question is from the line of Ravi Swaminathan from Spark Capital. Please go ahead.
Hi, sir. Just had one question. Hi, sir. Regarding the Michigan acquisition, can you give some more color on it? What is the strategy behind that? What is the thought process behind acquiring the Michigan entity?
Okay. If you remember in my past calls, we said one of our strategic focus areas is the U.S., and within that we said our inorganic strategy as part in our global thing is to look at organizations that will give us access to customers, which basically meant distribution and service companies. So Michigan Air was, and we also, as part of our BCG project in the U.S., we identified the top metropolitan areas that we should focus on. And right now, our strategic focus is on the top 20, and Michigan or the Detroit served area is in the top 5. So, as part of developing one of the top 5 market segments, geographical segments in the U.S., we have already been in touch with Michigan Air, and they were already distributing our products for the last 1.5 years, and we had an opportunity to acquire them because the owner was wanting to exit the business, and there was a very strong strategic fit because it belonged to the geographical area which is in the top 5. It was already distributing our product. The people were conversant with our products. Our people knew all of their people. The cultural and social fit of the organization was very good, and therefore we acquired the company. And so that's the logic behind the acquisition of Michigan.
Okay. And Michigan covers the northern part of USA, and Patents covers the southern part of USA. That is also an intention? I mean, so basically geographically also?
No. See, Michigan Air has 2 branches, one in Grand Rapids and one in Detroit. So if you look at the state of Michigan, there is the lower peninsula and the upper peninsula. Bulk of the economic activity is in the lower peninsula. So Michigan Air, by virtue of these 2 branches, will be able to cover the primary economic activity of the state of Michigan, which is the lower peninsula of Michigan. As opposed to that, Patents has 7 branches and they cover 4 states. So Patents has a much larger territory, so it's not like Michigan Air is going to expand beyond Michigan.
Okay. Got it, sir. And my last question is, so basically regarding the employee cost, you had given a detailed breakup. But one doubt regarding the Europe employee cost, so basically you had mentioned that over the next 3 years we will be spending 160 crores, right? I mean, with respect to employee cost alone, or is it total?
No. It is the loss of the operation, which includes employee costs, fixed costs, other fixed costs, after the sales that we plan to do for the first 3 years. Okay.
So this cost would remain, but sales would pick up after the 3rd year, and gradually from next year onwards.
Sales is already coming in as we speak, Ravi. It is going to reach a point at the end of the 3rd year we will break even, right? So on the fourth and fifth year, we will be able to recover the cost.
Got it, sir. And how much amount of that, I mean, in this quarter, how much amount of that loss, fixed cost related to Europe is there embedded in the number, roughly?
Well, the sales is hardly anything. So if you take the people cost and fixed and the other fixed costs that I was talking about, close to about 85 million is sitting as a cost due to the loss of the operations of LG Europe.
Got it, sir. Okay, sir. Okay, sir. Thanks, sir. Thanks a lot, sir.
Thank you. Anyone who wishes to ask a question, you may press star and 1. Next question is from the line of Rajat Shivram from ICICI Securities. Please go ahead.
Yeah. Hi, sir.
Hi, Rajat.
Yeah, just a small when we listened to Concall, they had shown growth in the compressor segment under their industrials. That means the compressor engines that they sell to compressor manufacturers. So why we are showing a disconnect while they are showing a growth in the engine? So what explains that variance?
See, there are two aspects to this. One is our market share in the water well segment is not as strong as it used to be. So we've lost market share, and this is something that I acknowledged about 3-4 years ago. And we are in the process of building that share over a period of time. To that extent, the growth in our water well business is not as strong as what the total engine sale that Cummins has got. The second part of the story is there is a certain amount of inventory that is sitting, engine inventory that is sitting. So we have to see what is the result on a longer time frame, whether that pattern is being sustained by Cummins. Now, we have initiatives in the water well segment even as we speak, but my optimism to get that share back in a very short time is not very high, but I'm optimistic that we have some very strong programs to recover it. So, to answer your question, the gap between the sales growth that Cummins has projected for the compressor segment and our inability to deliver growth in that segment that uses those engines is partly because we have lost our share in that market. The competitor is definitely stronger than us. And partly it is also there is a buildup of inventory.
And is this competitor inorganic, or you see a strong organic competitor trying to gain foothold in this market?
I don't understand what you mean by inorganic competitor.
So not organic. Is it kind of a what do you call unorganized?
No. These are all organized players. These are all large machines used in the water well segment. So these are organized players.
Okay, and that means that they have tried to reduce the prices and increase the price competitively.
No. So this market behaves on the basis of opinion leaders buy a machine, then everyone follows. We used to be a dominant player, and that time the opinion leaders favored LG, and everyone kind of worked with LG. We 4 years ago with one issue, about 4 years ago with one of our machines, and at the same time the competitor was able to grab our share of the market, and the market is staying with the competitor on the basis of inertia. So we need to break that inertia with a value proposition that is compellingly strong so that we can change the opinion leaders and therefore move the momentum of the market from inertia towards LG towards momentum for LG. So that's really the strategy we're working on.
Okay, and sir, we hear a lot of investment from the government towards the road sector. So road construction uses a lot of compressors. So are you not excited regarding those investment outlook?
So you got to wind back to the financial year 18-19 when we had a good growth, if you look at our numbers, and that was on the back, both 17-18, 18-19, that was on the back of large amount of roads that were being built, and the ministry was really talking about so many kilometers per day of roads being built in the country. At that time, there was a huge increase in the demand for our products from the construction, primarily the construction segment involved in road building. Now, what has happened and what we are hearing is two things. One, most of the customers who buy our compressors for this particular industry vertical are contractors who get these contracts from the people who bid for building the roads. Now, these contractors so one is there is a high levels of stickiness in the payment that is due to all these contractors who got these tenders from the government. Their payments have become sluggish. And two, the financing, because these are all not bank finance, these are secondary and tertiary institutions that finance these contractors. Those financing options have kind of become a little dull. As a consequence, the demand overall is low. This budget, they've again talked about infrastructure and building it. We need to wait and see how much the back dues are paid out. Unless that liquidity gets back into the market, it'll be difficult for contractors to bid for more tenders, because how do they finance it? There is a problem.
Okay, sir. Thanks for that detailed explanation. I'll get back in queue.
Yeah. Thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. Next question is from the line of Manish Goyal from Enam Holdings Private Limited. Please go ahead.
Thank you so much. Very good evening, sir.
Hi, Manish. How are you?
Good, sir. Thank you so much. Sorry to harp again. Just to clarify, so the number you mentioned about 20 million euro operational loss, that is in the peak, that will peak out into 2022, or it's a cumulative number?
It's a cumulative number from now onwards, 2021, 21, 22, 22, 23.
Okay.
It's a
cumulative number. And so ideally, like, say, on a yearly basis, if you can give a sense as to what could be the annual number in a range. I'm not asking for an exact number, but like if you want to put a number, that is it that this loss number will peak in 2022, and what number likely it could be, number one. And number two, you mentioned from the third year it breaks even. So ideally we are talking about 22 and 23. So what kind of sales would you require to break even?
So our break even is going to happen at around between 70 and 75 million.
Okay.
Now our starting EBIT loss for 2021 is going to be about 12 million. It will go up to 18 and then peak at 20. So 12 plus another 6 plus another 1.
Okay. So
that comes to 19 to 20 million at the end of the third year.
Okay, so this in FY23, 19 million euro loss will be the cumulative number you will reach.
Yes.
Okay, but
FY 2023. 22,
23. Fine, sir.
Yeah.
But you also mentioned that you expect revenues of 75 to 80 million euro in fifth year. So, so that will be ideally 24, 25.
Yes, 24, 25, we will break even. cumulatively.
Okay. So, okay. Got it.
So 22-23 will be the peak. After that, it will slide down, the cumulative losses. And the next 2 years after 22-23, we will break even cumulatively.
And if you can just share what could be the revenue number you are expecting in FY21. So that gives us a complete perspective as to how...
Manish, I don't want to give up the entire business plan to the competitor. I'll be happy to...
Sorry, sir.
My point is, 24-25, we will hit about 75 to 80 million, right? That we are confident. Now, today, and this includes the performance of industrial compressors in Italy, which is around 5 million, right?
Okay.
In this year.
Okay.
Without any of the team fully in place, right?
Okay.
So it is like a hockey stick growth that we are looking at. Yeah.
Sure. And is it been now we are looking for this sales ramp up in Europe? Is it also driven by our new product oil free, or how is it? Are you probably looking at the entire?
It's a combination of two things, Manish. So if you look at what did we do in Italy, we went into Italy really effectively speaking 2014 with our industrial machines. Okay.
Right.
So 2014 to 2019, which is a 5-year period, we've been able to grow Italy to 5 million, right?
Mm-hmm.
Now, Italy is the most competitive market because there are close to probably the largest number of compressor players in Europe.
Mm-hmm.
Now, what this has told us is that the market is acceptance of our product is very high. The performance is appreciated. The quality levels are recognized. Our service commitment is also viewed very positively, right? So this has given us the confidence that we can now expand, because the behavior in most other markets will be, in terms of pricing, they're better than Italy, and in terms of receptivity, they will be there, right?
Sure.
And we have built a team of people with the most critical, we have built a team of people with very strong compressor industry experience, with very strong relationships with distributors in their respective countries.
Right.
So they have given up very good and strong positions in well-established large compressor manufacturers and joined us because they have done their due diligence in the marketplace about LG's performance, not only in Europe, but in Italy, but also in the US and elsewhere.
Right. Okay.
So they recognize that here is a company that has the potential, and therefore they've come on board on the basis of that high amount of faith and belief that they have.
Right. Okay.
So it's a little different from what we have done in Italy and very different from what we've done in the US.
Sure. Okay. And sir, just one more clarification on the one-time expenses. You mentioned that in Belgium you had a 3 crore one-time expense which was related to recruitment. Plus you had 1.5 crore in US related to your facility. The escrow amount that we had to give up. Right. And then another 70 lakhs is for the basically fraud which happened in the Middle East.
About 80 lakhs. 80
lakhs. Okay. So these are clearly one-time items sitting in the other expenses.
Yeah.
Okay. Sir, coming just to, if you can provide more perspective on how has been our new product oil free has been doing in India as well as global markets, sir?
I'm sure my main competitor who's got oil free is listening in on this, or will eventually listen in on this. So, but I will tell you, Manish, that this is a vertical that has grown well for us this year in spite of the industrial challenges elsewhere, right? Our oil-free business, both the conventional as well as AB, which is our water-injected machine, has grown in India, and we are quite satisfied with the performance of this particular vertical. In addition, even as we speak, we have got 2 very strong reference orders in France for our water-injected machine, which is again a testimony for the value of the product for the customer. We've got a couple of orders already in the U.S. And we are creating organizational focus in both these markets to try and drive the business of this product line. So I'm quite happy that we're putting a lot of emphasis in building out the range and also bringing focus into the market for this product line.
Sure. And last question, sir, I had on the aftermarket. How has it been performing in India and overseas? Because that is one area where we were looking to increase our focus.
The aftermarket in India has not grown to the extent that we budgeted it to grow, and the reason that we are observing is many of the customers are not running full shifts.
Okay.
And as a consequence, the need for parts and service, which is dependent on the running hours of the machine, has come down.
Okay.
Now, having said that, I will be the first to admit that I still believe there's a much larger opportunity. We need to continue to drive our strategy to the next level for building our aftermarket, which is something that we are, even as we speak, we are working on doing. And I'm hoping that from the second half of next year, we'll start seeing some significant movements beyond. We did strengthen our position in the last 3 to 4 years. We significantly strengthened our position in aftermarket, but the opportunity is even larger, and we recognize that. And we're going to, the current organization needs to be tweaked and augmented, not necessarily adding more people, which we are we are going to be very judicious about. But it's about bringing the right strategic focus in the right markets. We've recognized it, and you'll start seeing some impact from the second half of next year.
Right, sir. And I may squeeze one more question on servicing the Europe market. Will India be acting as a base for supplying the products, or how will it be?
Absolutely. All the products that are currently sold, the industrial products that are currently being sold in Europe, will be manufactured out of India.
Wonderful, sir. Thank you so much. Thanks, sir.
Thank you, Manish.
Thank you. Anyone who wishes to ask a question, you may press star and 1. Ladies and gentlemen, you may press star and 1 to ask a question.
Jay, just if you can highlight the point you mentioned about infrastructure, construction not done well, water also has not been doing well. How the other pockets, have they all been in the declining mode, or some of the pockets have held firm in this current environment, maybe food, FMCG, or automotive or other segments, if you can just touch upon that?
Sure. Automotive, as you can imagine, Kamlesh, has been quite bad.
Yeah.
But food and beverage has done well. Pharmaceutical has done well. Textiles in pockets has done well. So I can't think of any other. There is some conversation there was some conversation in cement, but that has died down a bit. Steel, there could be. Once the idle assets are picked up, we'll have to see how the steel industry. There seems to be a revival of investment, but it's still early days. So while there are broadly most of the industry verticals are paused, have hit the pause button, there are some specific shoots in like the verticals that I talked about.
Mm-hmm. Okay. Secondly, about the Michigan company which you acquired, how big is the sales team there?
I don't have the sales team's number. We have the total strength of the company is about number of people. 1 second. The total number of people in Michigan Air is about 24. A large, I think in administrative, there are only about 5 or 6 people. The balance number are primarily in service and sales. A disproportionately large number of people we have in service. So I don't have the specific breakup with me.
Okay. And how much has we invested in terms of the overall capex for the year, and any further amount we are likely to invest this year?
Okay. Let me give you the situation on the present debt level, and in that context, I will answer your question. So if you look at our net debt position is about 250 crores. And we started the year with a net debt position of 115 crores. So we've increased our net debt by about 135. Of that 135, close to 115 crores is from acquisitions. Now, what are the acquisitions? We did primarily, we took over the portable business from the distributor and the inventory that came along with it. There was a closing out of Pulfords. There was an earn-out in Pulfords after 1 year. That is something that we paid out of this, and the acquisition of Michigan Air. So these are the main elements. So the 115, if you remove, there is a increase of about 120 crores over and above what has been contributed by, I'll rewrite it. 135 crores is the increase in the net debt position, of which 115 crores is the acquisition cost. We have generated cash of about 80 crores. So ideally, our debt should have been lower than we should have been lower by about 60 crores. But the main problem has been the contributor for that 60 crores has been primarily the inventory and receivables. That inventory, again, the biggest contributor is India, and the reason is that we had planned certain growth based on certain inquiries. The inventories were built up because especially the long lead items, we had taken a position. But those are, even as we speak, we are progressively reducing it. We took on a huge amount of inventory in the U.S. that is going to come down. So it is internal management of our working capital, which we are quite on top of it, both on the receivable side and on the inventory side. You will see significant changes in when we do our results. I believe when you look at our first quarter results of next year, you will see a big significant shift.
Mm-hmm. Okay. And when you said that the Indian...
Sorry, you had asked a question about
CapEx.
Yeah. The CapEx that we have spent so far is about 40 crores, and this includes capital decisions that come as far back as 17, 18, machinery that we had ordered, part payment, validation that has come in to the plant this year, and last 18, 19 investments that spilled over into 19, 20.
So incrementally, any further investment this year we have to make?
There may be about, in my expectation, maybe 10 or 12 crores.
Okay.
But next year is going to be a significant reduction.
Okay. And Jay, when you said that the manpower cost in India was higher, and now we are calibrating the same in terms of not building the upfront cost. So should we assume the employee cost at the current level is going to be staying stable at least for a while till the market recovers in Indian operations?
That's really the goal, Kamlesh. What we are looking at is our planning of manpower cost is on the assumption that India is going to flatline, even though we have some pretty interesting plans that we are working to build a top line, but our assumption as far as planning manpower cost is that it's going to be flatline. But having said that, we can't just take a blanket decision across all categories of people. There are some people, for instance, the blue-collar employees at the bottom, we need to make sure that there is a certain equitable contribution to their sustenance, their standard of living, as well as some junior level employees for whom, salary is a basic sustenance. So we will take a very differentiated, discriminatory approach to this. At the same time, we will also be looking at where there is unnecessary headcount that is not really adding value to the organization. Because if you look at the last probably 3 years prior to this calendar year, there was a certain optimism, and I believe that that optimism, we made the better of us, took control over us. So we need to go back and revisit that, which we will do.
All right. Okay. Do you have any further questions in the queue?
No, sir, we don't have anyone in the question queue.
Okay. So, any closing remark you would like to make, Jai?
I just want to say that, while the numbers at one level look quite gloomy, the fundamentals of the business are quite positive. Like I said, we are not a company that is going to produce glamorous results in a very short time. We've got a trajectory plan. We have a strategy plan. We are staying true to that strategy. This is a hiccup in one of the key markets named India. If India had delivered like it did last year, the numbers would be completely different, and all our strategic costs and investments will not look so glaringly like a sticking out iceberg. So this is really the thing, but this is par for the course. These things happen in some of the markets. We are calibrating and we will move ahead, and I'm very confident that we will get on top of these things.
Great.
So that's really the message that I want to leave everyone.
Sure. Thanks, everyone. So with that, we conclude the call. Thank you for hearing.
Thank you very much.